Hello and welcome to the second class in Chapter 13. This one will cover after-tax analysis, including depreciation, and this will cover Section 13.3 and pages 393 through 401. The other material here is the same as recent classes. The Section 13.3 deals with after-tax cash flow or after-tax study. The first equation that we're dealing with is when you own an asset in a business and then you sell it, we call that selling price the salvage value. So the salvage value or the selling price, generally these are the same quantity, and at that selling price, that's not part of your ordinary business. You're not in business to sell your assets. You use those assets to produce income and to produce something, a goods or services, and those goods and services you charge for, and that's your ordinary income. But when you sell the assets, that's special, and so we account for it differently. Depends on the relationship between the selling price that you sell the asset for and what it's carried on and what value it has on the books of the company. Remember last chapter we talked about using depreciation as a tax deduction, and we continue that discussion, of course, in this chapter. But we also, each time we depreciate an asset, that is, take another deduction, tax deduction, we are decreasing the value on the books of the company of that asset. So the remaining value is called the book value. And there are three possible situations when you sell the asset, and we're going to cover each of those. But I'm going to show you a graphic first that describes these three situations. And this is one of your figures in the book, but basically the most common situation, he calls it SP2, and that is where your book value, and recall, if you keep an asset beyond its asset life according to MACRS depreciation, MACRS depreciation depreciates an asset all the way down to zero book value. And that's one of the unique, one of the features of MACRS. And I'm going to go to the last slide that I have in this set of notes. Recall this table from Chapter 12, which I will have with your final exam. You don't have to memorize any of this, but if you add up every one of these columns, they all add up to 1 or 100%. So that means you depreciate 100% of the price of the asset as long as it lasts 1 year beyond what we call the property category. For example, 5-year properties depreciated over 6 years. And remember, I talked about that being because of the half-year convention. You only get half of the depreciation that you might have gotten the first year, so you get another half the last year. So 5-year property is totally depreciated after 6 years. There's the book value has gone to zero then. 3-year property is totally depreciated after 4 years, and 7-year property after 8 years, and so on for 10, 15, and 20-year property. So what we want to talk about the different situations is the relationship between the asset's price, selling price, and the book value. Okay, this is your book value. So and the most common case is what he calls SP2, which I'm going to talk about first. I'm going to say that's my first case because it's the most common case. And that's where you sell the asset for a little bit more than your book value. The income that you receive from that asset then is called depreciation recapture. And you have to pay tax on that because you took deductions, depreciation deductions, all the way from the price of the asset all the way down to the book value. So you took more depreciation than the asset really appreciated because its selling price is not zero now, or the book value, it's above the book value. Okay, but it's not above the price, what you originally paid for it. We'll cover that case in a little bit. But so this is the case that I'm covering right now. And so when that's the case, I call that the first situation. Okay, and the most common situation is where the selling price, which in this figure is called SP2, the selling price is less than the original price. Okay, it's less than that P, but it's greater than the book value. Okay, in that case, that's called depreciation recapture, and you take the difference between the selling price and the book value, or SP2 and book value. Okay, so that's this distance here that's shaded here, and that's called depreciation recapture, and you have to pay tax on that. Okay, so the second situation is called a capital gain, and that is where that's called SP1 in this figure, and that's where the actual selling price is more than you paid for the asset. Well, you might say, well, that's very unlikely. Well, it is with manufacturing equipment, which is the most common kinds of things we deal with, but it's not unusual at all with real estate. And the example I like to think of is, say you bought an apartment building in a major growing city like Houston, Dallas, San Antonio, Austin. You kept the building for, say, 10 years. You rented it out. Hopefully you made some money. When you go to sell that building, it's probably worth more than you paid for it because real estate has gone up in price. And so you sell it for more than you paid for it, but during those 10 years, you were depreciating it. You were saying on your books, the value of this property is going down. In fact, the property wasn't going down, it was going up. That's okay. The law allows you to do that. So that's called a capital gain. And the capital gain is the difference between the selling price now, like the salvage value, and what you originally paid for it. So that's this distance SP1 down to here. Well, if you sell it for SP1 dollars, which is greater than the original price, then on the books it's still here down here at book value. So this part of the gain is called capital gains, and this part is called depreciation recapture. But you have to pay tax on both of those, okay? Because it's on your books as this value, and you're selling it for that value, okay? So now there's another situation. I guess the flip side of that would be where you actually get less than the book value when you sell the asset, and that would be a case where maybe you invested in a bad apartment building. It was in a bad part of town, and it went down in value, and it went down in value so fast it went down more than you depreciated it. So you paid this much, you took all this depreciation. When you go to sell it, you can't even sell it for that book value. So you take a capital loss. and that has to be accounted for then also. And so those are the three things that we have to now modify the taxable income equation that we came up with at the very beginning of chapter 13. Recall that chapter just had the taxable income was the gross income minus the operating expenses minus the depreciation. Well, now we have to add in two more items to that, and that is starting with gross income minus operating expenses minus depreciation. We add in depreciation recapture, that's equation 10. We add in capital gain, equation 11, or we add in a capital loss. You can't have all three of these. You could have just this one, or in other words, you could have just this one, depreciation recapture, or you could have this and this. That's a possibility. If you have this, you always have this. Okay, so you could have this only, or this and this, or just this. Okay, so the capital loss is basically a negative number. Okay, so that's going to subtract from your depreciation. I think I'm showing it here as a book value because SP3 is below book value. So either I need to change this equation by switching the sign, or I need to make this a minus. Okay, so I'll modify that in the lecture notes when I actually publish them online. So that's how this figure is interpreted. Now I'm going to do an example problem. This is example problem 13.4 in your textbook, and it says Biotech, which is the name of the company's, buys a cell analysis system, one of two. We've got two alternatives, and he wants to minimize, the CEO wants to minimize the total taxes. Well, that's kind of a dumb requirement. I'd say you'd want to maximize profit, but anyway, that's what he wants to do. He wants to minimize total. The equivalent tax rate is 35%. That's given as part of this example. And so Analyzer 1 has a first cost of $150,000 and operating expenses of $30,000 a year for 5 years. It's 5-year recovery property, sorry. We're only going to keep this asset 3 years because they have a 3-year contract, okay? Analyzer 2 costs $225,000 but only has $1,000 a year operating expenses, and it is also 5-year property. So remember, 5-year property now, if we go back to our depreciation table, the first year we're going to depreciate 20%, the second year 32%, and the third year 19.2% of the original price of the asset. It's called P, or the original basis B. So he's looking at the depreciation and then the taxes. Well, depreciation, taxable income, and then taxes. Okay, and taxes are, of course, 35% of taxable income. Okay, so Analyzer 1 costs $150,000, so the depreciation in year 1 is 20% of that number. So 0.2 times this is $30,000 in depreciation. And then in the second year, it's 32%. So we'll take 32% of $150,000 to get $48,000, and then it's 19.2% the third year, and that's $28,800. So from the gross income to get taxable income, remember taxable income, the equation I just presented was, and we presented it last time as well, gross income minus expenses minus depreciation. So when I subtract expenses and depreciation from gross income, I get 60,000 subtracted from 40,000, from 100,000, which leaves me with 40,000. And then the second year, I get 30,000 plus 48,000, which is 78, subtracted from 100, which leaves me with 22,000. And then the third year, I have 28,800 plus 30,000, which gives me 58,800, subtracted from 100, leaves me with 43,200. Then I multiply these, here 41,200. Then I multiply these taxable incomes times 35% to get the taxes. And then I add them up to get the total taxes. Remember, that's what our CEO wanted us to do. So for the for option 1, the Analyzer 1, the total taxes that we pay is $36,120. For option 2, for the first 3 years, the initial cost is $225,000. So the depreciation numbers are going to be much larger, but the expenses are smaller. So anyway, the first year, if we take 20% of 220,000, we'll get depreciation of 45,000. So we add the 45 to the 10 to give us 55. Subtract that from 100,000, leaves us 45,000 taxable, multiplied by 35% to give us this number. And we'll do the same thing for years 2 and 3, and then we get that we paid taxes of $38,430. So Analyzer 1 gives you less taxes to pay the first 3 years, but it turns out that it may not be the best alternative. You really have to look at after-tax cash flow to determine that. Okay. Now this example problem has a second part to it, Part B, which I'll bring down here. Part B says Analyzer 1 is sold after 3 years. That's the end of the contract, for $130,000. Remember, that analyzer originally cost $150,000. It only went down in value to $20,000, and even though, how much had we depreciated? The book value after 3 years of that analyzer is $43,200. But we now are going to sell it for $130,000. That's a huge going to result in a huge depreciation recapture. Okay, here is the situation: we're selling it for $130,000. The book value is $43,200. So we're in this category here, SP2, and we're not all the way up to the price. Okay, the price was $150. We're selling it for $130, so we're way up here, and all of this amount is depreciation recapture. Okay, so you're going to have to pay tax on that, and notice then in year 3 now the taxable income, because of the depreciation recapture, is going to be much higher. Okay. Remember, now we modified the equation that I gave here. Taxable income equal gross income minus operating expenses minus depreciation. Now we're going to add in, this is equation 13.1. We added in depreciation recapture, capital gains, capital loss. We don't have capital gains or capital loss in this particular case, so we can just forget about that, but we do have depreciation recapture. So we have to add that in. And when we do that, now the taxable income in year 3, without looking at selling it for $130,000, the depreciation, the taxable income in year 3 was only $41,200. Now, because we have so much depreciation recapture, it's $128,000. Wow. So anyway, bottom line is you're going to have to pay a lot more taxes in year 3. Years 2 and 1 are the same. Okay, and so this is the cash flow after taxes minus $150,000 in year 1, and then in year 3, well, you also have this as income, so that's nice. That's good. Yeah, so now your income is $230,000, and you have expenses of 30, so we can subtract that, and then you have depreciation of 28.8, and so you end up with taxable income of $128,000, and then you pay tax at 35%, which leaves you with $155,000 after taxes. For Analyzer 2, you're able to sell that for the exact same amount that you bought it for, $225,000. That's very unusual, but that's the case. So every bit of depreciation you took is now going to have to be recaptured, because it's not above the original price where you have a capital gain. There is no capital gain, but all the depreciation has to be recaptured, which is the sum of these 3 years of depreciation. Okay, so when you do that, then your taxable becomes this number here, $207,000, and you're paying tax at 35%, which gives you that for taxes, and then this is the net cash flow after taxes. And in the next session, I'll probably work another after-tax problem for you, but this will suffice for today. The second example, example 13.5, is a fiber optics manufacturing line costing $50,000. So that's what the original price was, and it's 5-year property. And the author shows you a table, this is table 13.6, where this after tax, these taxes are based on straight line depreciation, which we talked about, but we really didn't cover it. And then this middle section is based on double declining balance, and we talked about that, but we really didn't cover it. And then finally, the last section is what we really deal with, which is MACRS depreciation. Okay, and this method, we're going to look at the cash flow before taxes, which is $20,000, and then we're going to take depreciation using 5-year property and figure out how much that is. Well, the first year, it's 20% of the original price. Okay, 20% of 50,000 is 10,000. So your depreciation's 10,000. Cash flow before taxes is 20,000. Remember, cash flow before taxes. This cash flow before taxes is gross income minus operating expenses, GI minus E. Then we subtract the D from that to get taxable, and that's 10,000. And the tax rate on this one is 35%. This is also part of the problem, 35%. And so you get taxes of $3,500 the first year. The second year, your cash flow before taxes is the same, 20,000, but this year we get to take 32% of the original price for 5-year property, and that turns out to be 16,000. And so 20,000 minus 16,000 leaves us with 4,000 that's taxable at 35%, leaves us 1,400 in taxes, and so on down the line. You should be able to do this at this point in time. I've also included with these lecture notes a copy of this table 12.2 again, just so you'll have it. And as I said earlier, I will include this one, this table, with your test paper or test materials for the final exam. So you don't have to bring this with you, or so that for the final. So that concludes today's lesson on after-tax cash flows. I may do one more, and I may not. I may just work some problems for you. That's what I plan to do, is one more session on Chapter 13, which will be a problem session. And thank you for your attention.